the evidence shows that a number of active fund managers are battling to beat their benchmark indices. If one considers the low fees linked to passive exchange-traded funds, there seems to be a growing argument to keep it simple with index investing. Add to that the development of so-called smart beta products that aim to copy the styles of active managers, and it gets interesting. Joining us in our Cape Town studio to discuss the alternatives is Marius Fenwick, COO of Mazars Financial Services. Hi, Marius. So presumably this is a story that you believe. We've been hearing slowly, the voices are getting louder on this, that it makes sense to have this core satellite portfolio where the core is an index, and then you can spice it up with some satellite active management funds. Would that be your approach?
Yes, I think so. I think it basically starts at the costing principle. I think whenever investments are under pressure and returns are under pressure, like we're seeing at the moment, when margins are squeezed, then the first thing that comes to mind is that how do you actually reduce those costs? And I think that's where ETFs, for one, makes a very, very good and strong point. And the core satellite approach, I think with availability of the ETFs that's available, plus the development on the smart ETF side, I think that's most certainly something to watch in future.
Marius, just from some of the research I've done into the subject, we've seen that there's obviously a couple of indexes that people could use as a proxy for the market. And obviously there's the development of smart beta products as well. What's your sort of advice to investors around which indices and ETFs to use to get exposure to the market, whatever you consider that to be defined as?
Yeah. Warren, it's a fairly personal thing, but I think if one looks at the, if you look at the All 40, it's pretty skewed. It's pretty resources weighted, and you must probably have a few single shares that make up the bulk of that. I like the principle where one can most probably ferret out a bit of the averages and look at something like a beta, where you look at averaging of all 40 stocks at 2.5% per stock. I think that's a great way of looking at it. I think if we look at where a lot of returns come from shares, you look at dividends. So I like the ETF, the Divi, which focuses on 30 shares on the mid cap and large cap stocks. I think that's great. If you look at the SWIX, where they take out the component of offshore investors and to a large extent some of the resources as well, so you get a more South African representative option. So those was probably the ones that'll favor, and the RAFT. RAFT is great as well.
Just in terms of the RAFT, that's obviously intellectual property developed by research affiliates overseas. I think just for the benefit of our viewers, please tell us what specifically we mean by smart beta. And we've seen Absa Capital being quite aggressive in this space, bringing to market the likes of the Momentum and the eRAFI suite of products. So perhaps a description of what it means to be smart beta and some of the products that investors could consider in their portfolios.
Yeah, well, look, the RAFI was developed in association with, I think, Plexus. They've got a contract with the overseas company, and what they look at is they look at fundamentals, and they look at the cash flow of a company. They look at the pricing, the sales. So they look at the fundamentals of it, and that's basically a black box that goes into it, and it comes up with a figure that basically nominates. So it takes out the human element, and it's basically done on fundamental principles.
At this point, obviously, there's also the introduction now, well, many South African investors choose to hand over the asset allocation decision to portfolio managers, and we've seen the likes of the balanced funds becoming some of the biggest funds by assets in the market. Absa recently introduced the Protect and the Growth MAPS ETFs. What's your sort of suggestion or advice to investors around using multi-asset ETFs and building a replica balanced fund for their own portfolio?
Yeah, I think if we look at the ETF, let's call it balanced fund space, I think the shortfall there is basically the fixed exposure to bonds at the moment. Where the bond markets at the moment, I don't think we're going to see the real capital growth coming through on bonds. Where interest rates are, we know if interest rates start going up, the results are inverse with bonds. So I think that's maybe the one shortfall on your passive, call it ETF balanced funds. They still have a fair amount of exposure to corporate bonds, not allowing, I think, exposure into your corporate bonds where there might be a bit of value going forward. So from my perspective, if one looks at a core satellite approach, maybe the active management space should be the place where the core is, and then build the satellites with ETFs, whether through property ETFs or your smart ETFs on the equity space.
Marius, just in terms of the actual use of the vehicle, when you select a passive strategy, that's one step, and then many investors are confronted with either purchasing the ETFs, which is directly onto the JSE, or using a passive unit trust fund. In terms of fees and charges, where do the two stack up, and what's your preferred method?
Yeah, at the moment, my preferred method, just from simplicity point and from managing the portfolio, is most probably the unit trust route on an ETF platform. If you look at something like iTransact, I think that's a great place to do it. Entrance cost is low. I mean, you can start off with a monthly debit order of like 450 Rand for three portfolios on the monthly debit order. The one downside a bit is, I think, due to the fairly low volumes at the moment, your administration costs on a platform is still relatively high compared to your unit trust side, and I think that's must probably amplified by, on the unit trust side, your fund managers still pass on rebates, and the low fees on the management side from ETFs. I don't think there's enough in it to pass on a rebate to the platforms. But I think as volumes pick up and it becomes really competitive, I think, watch the space. I think they'll really come through and be the choice of the future.
Marius, just a final question. We've seen that the uptake of ETFs has been pretty slow in the market, and we've got assets under management, including all the exchange traded notes, of about 45 billion, which is quite small for the size of South Africa's retirement savings market, for instance. What are some of the impediments you think are holding back the use of ETFs by the likes of independent financial advisors and pension funds at the institutional level?
I think one of the big problems is the distribution channels. I think the advisory market is still used to working either with the life insurance companies or the linked unit trust companies. All those unit trust linked companies do not have the facilities to offer ETFs. I think they're slowly looking at it. Some of them are starting to offer it. I know that Investec most certainly has introduced some of them. So I think as the offering progresses on the platforms, you'll see that coming through. And also the advisors need to understand it. I think it's a fairly complex investment environment if you look at all the investments out there on offer. So ETFs is another arrow in the quiver. So I think they just need to get their heads around that. And I think in time, once they realize the value and the potential of outperforming the average fund manager out there, and don't get me wrong, there are some very good fund managers that I think will always add value.
It's just a matter of finding them.
There are too many guys out there that don't. So yes. I think on that space, knowing that you're going to get the market, it's a safe bet to go for the ETF and not underperform the market, barring the transactional costs. Yes.